My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you a little money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We keep losing viable groups as formerly terrific sectors go flat. That's one of the main reasons why this market has become so frustrating. It's a real threat to whatever bull markets are left. And the ones that are left out, boy, are they painful. The recent sell-offs, they're much more extreme than our rallies. We just don't have enough sectors with strong prospects, which leads to a shortage of viable stocks. And that's why the universe of winners is so narrow here. Even on a day where the averages rebounded hard from the lows, Dow finishing off just 10 points, S&P dipping 0.13%, NASDAQ declined 0.12%, was positive for some of the day. You know, as I say every night, there is always a bull market somewhere, but darn, it's getting pretty hard to find it. So tonight I want to talk about what's happened, about some of the vanishing bull markets, the ones that are at the precipice or tipped, because you need to know how this business has become so darn hard. What's causing these bull markets to morph into bear markets? Is it interest rates, strapped consumer, end of the post-COVID heyday? Maybe a little bit of all of them? Why don't we go down the list, you and me? The list of the lost bulls. Maybe we can find a couple. Let's start with what has been a real stalwart, travel and leisure. When we were locked up with COVID, we craved travel and going out. When the pandemic ended, we realized we were long on money, but short on time. So we set out for points unknown. That drove the airlines, the hotels, restaurant stocks higher. Just an incredible bull market. But in the last few weeks, with the rise in fuel costs and the decrease in disposable income because of tightening credit, we pretty much obliterated the entire thesis. Everything from Disney to Marriott to Delta to Darden to Carnival has been nothing short of disastrous.
The House of Pain.
Same goes with American Express, Airbnb. It doesn't matter how well they're doing. We're talking about the stocks, not the companies. Wall Street has collectively rendered a judgment that next year has to be worse than this year. Given the spike they had post-COVID, the travel and leisure stocks are now among the most accursed post-COVID hangover cohort we have. There's no more escaping it than there is escaping the declines in Zoom or Moderna and Pfizer, arguably the three biggest winners during the pandemic, and then the losers after it. How bad is this travel and leisure bust? Marriott just had an analyst meeting where they talked about great growth ahead and nobody cared. The cruise lines, they have phenomenal bookings. The assumption is they simply can't last. Sure, Disney has tepid Disney World numbers in Florida, but they're still above the 2019 level. And Disneyland's jam-packed. Shanghai Disney's incredibly strong. Their cruise ships are booked solid. All that happens, though, is that dripping of Disney's market cap. It's been poleaxed beyond all recognition if you back it out, which is hard for me to watch because my travel trust has been a buyer. And the restaurants? Well, now that Eli Lilly and Novo Nordisk have drugs that knock out cravings for food, how the heck do we start buying McDonald's with that Big Mac fries and Diet Coke? I bet McDonald's sells fewer and fewer as these new weight loss drugs become more and more popular, and therefore those foods become less and less tasty. More on that later, but trust me when I say, for many people on Wegovy or Mounjaro, that's the Novo Nordisk and Lilly drugs, a cheesecake factory is about as appetizing as a tool and die factory. Almost no group has been hurt as badly as the airlines because they lost the business traveler and they had to raise fares to ever higher levels in order to stay ahead of jet fuel. The airlines seem to have priced themselves out of growth. They're casualties of, well, everything. Huh? Next group was housing. For the longest time, the home builders had shown tremendous restraint, building just what was needed and seemingly not a house more. That was fantastic for Toll Brothers, Lennar, Pulte, D.R. Horton, KB Home. Given that we had a tremendous housing shortage in this country, these companies were able to continually raise prices. They were printing money, meeting very little resistance. Now, there is still tremendous demand out there, but mortgage rates have gotten so high, around 8%, versus, say, 3.5% not that long ago, that a substantial part of the population has indeed been priced out of the housing market. It's happened so quickly that it's possible we may have had a traditional housing cycle finally on our hands, where the homebuilders are still building, except it now looks like they may be building too aggressively, and the buyers are walking away because of those high mortgage rates. I have no doubt that there are many people who want a home, but if they can't afford it, it doesn't matter. We know the Fed's very concerned that home prices have gotten too high. Higher mortgage rates will make it so there are more homes left on the market, which historically has led to more affordable housing. The cycle might be back. At the moment, there's still no excess inventory to speak of. But just like the travel stocks have come down despite strong bookings, the housing stocks are telling us that the housing bull market, stick a fork in it. When the economy teeters toward a recession, historically, we're supposed to reach for the food stocks, the staples. But what if these new weight loss drugs, those are the GLP-1s that I talked about, continue to take the country by storm? What if Walmart's almost offhanded comments about how they're starting to see sales being impacted by these drugs become even, I don't know, much more standoutish? I don't know what to say. It was so offhanded. But do you really want to own Smucker's knowing it paid more than $5 billion for Hostess? The owner of Twinkies and Ho-Ho's, part of the potentially disrupted snack category that maybe Walmart's talking about? I can easily argue that people always love junk food, and not everyone's going to take these expensive new drugs. However, we're not in that kind of market. People are now assuming that everyone will take the expensive new drugs, and that the whole category is going to be disrupted. If Marriott's stock can be savaged, even though it just said business is great and Marriott's a trusted brand, what are you supposed to think about Smucker? Or how about Conagra, which is on tonight? They're talking about a stretched consumer not buying some core staples they sell. But can the consumer be all that stretched with sub 4% unemployment and wage growth that the Fed thinks is too hot? Should we pay as much for this company's earnings as we did before the advent of these new weight loss drugs? I'm sure Conagra has many ways to boost sales, but this is a glass half empty market, people, and anything that might damage their future growth is viewed as a serious problem. How about retail? Now, we know there are cross currents everywhere. Some good, including robust employment. Some bad. Merchandise that might be too expensive because of inflation. But theft destroyed a lot of the good, and markdowns took down what was left. I think people have all but given up on a Walgreens and CVS giant chains because it's impossible for them to prevent theft without putting all the most popular stuff behind lock and key. Even Home Depot's got stealing issues. Same with Target. It's hard to find someone in the retail business that doesn't have this problem, except for Costco and Amazon, groups of pariah. Utilities crushed because not only are their dividends too small to compete with bonds, they need to borrow money constantly because this is an extremely capital-intensive industry. Telcos. Have you seen those stocks? AT&T down 19%, yielding suspicious 7.5%. Verizon, a suspect 8.4% yield. Capital-intensive industry, both need to borrow money endlessly. And don't forget the banks. They do poorly when interest rates go this high because these are levels where you begin to see real credit problems, something we haven't had to cope with in ages. Not that the bank stocks had run at all. They just feel doomed, especially the regional banks, which are deep in bear market mode. Now, of course, if we get a different interest rate environment, some of these bear markets can turn into bull markets. So I'm waiting for that employment number tomorrow morning at 8:30 again, though that's not the point. We've lost a ton of groups, and in their places, we've picked up none. Only tech has a real bull thesis right now, and many feel that that's already overdone because they don't think that AI can be that powerful. I think it can be. I think it's attractive. Bottom line, the bear is roaming free right now except in tech. It's irrepressible. Without more sectors changing their coloration, any rally will be constrained beyond a short oversold pop unless employment cools, wage growth goes negative, and interest rates finally retreat from their record run higher. Tyler in California. Tyler.
Hey, Big Booyah from California. How you doing, Jim?
Hey, good to talk to you, Tyler. What's happening?
Hey, I'd like to give a shout-out to my sister, Sasha. She's a new investor. And I'd like to ask about Clorox. Despite the bad earnings yesterday, should that be a long-term investment, or is that only a COVID play?
Okay, I went over their different brands today to try to figure out who took share during the cyber hack. The thesis is a failed one. Almost no one's going to take share from Clorox because they own the best names in the business, and no one's putting private label on Clorox. So let's do this. Let's just say that it only yields 3.8. I think you can go to 4.5 yield. Let's do it by yield. And that's when you can start buying Clorox, and not before then, because they don't seem to have their arms around all the problems with the hack, and it's only down 10% for the year, only. The universe of winners is narrowing right here, right now. Without more sectors changing their coloration, any rally could be constrained, and the bear might continue to roam free. On Mad Money tonight, I'm laser focused on the consumer packaged goods stocks and the impact of the GLP-1 drugs may have on the space. And I'm hearing if that concern could be warranted, maybe with Conagra Brands. Then Levi's reported after the bell, the quarter was not perfect. Let's find out more. I'm running through the numbers, talking to the company's top brass. And the beer business continues to drive strength, but Constellation stock sure didn't. What's happening there? I'm going to get a read on the sector and the stock with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.